Welcome to the New American Dream. I'm Rebecca Richardson, aka the Mortgage Mentor, and I find it so important that first-time home buyers really have correct and current information when it comes to what does it actually take to buy a home right now. So let's get into it. I'm Rebecca Richardson, aka the Mortgage Mentor, and I've been a loan officer for over 25 years. So what that means is that I have seen a lot of scenarios, helped a lot of buyers, and what I really try to do is to take that information and make things make sense, because I know when you are looking at buying a house, particularly if it's your first time, it is very overwhelming. There's a lot of information coming at you. So I take my experience in the industry and with my clients to help break this down into what are the pieces that you need to be aware of so you can take your dream and turn it into a reality of becoming a homeowner. Now, what I'm going to cover here, these are general concepts. So everybody's situation is different, and this isn't a commitment to lend, and there are a lot of different variables that go into somebody's individual approval, but I want you to understand the big pieces of how a loan gets approved and the things that you as a potential buyer will want to be paying attention to. So as a level set, I just wanted to start with why I'm calling this the New American Dream is, a lot of times we talk about, the American dream is to own a home, your 3-bedroom, 2-bath with 2 kids and a dog. And really that picture has changed and has been changing for a while, but we've really felt it within the last 5 years, particularly because of the run up in home prices due to super low rates that unfortunately probably are never coming back, because we don't want to be in the economic situation and the global situation that we were in, why rates were so low in 2020, 2021, those kind of things. But what that did was that basically spurred on a big rush into the market, lots of buying, higher buyer demand means home prices go up, and unfortunately incomes have not really kept up with that. So that has created somewhat of a gap that absolutely affects housing affordability. Somebody saying, oh, I saved up a couple months and I was able to buy my first house. Things are different. I get that. And I want to at least just acknowledge that from the standpoint of what's changed with rates, what's changed with home prices, and how that affects your options. The good news is that people buy homes every day, and with a lot of different scenarios and situations that probably look a lot like yours. So please don't give up hope. And that's what I really hope and intend for this class to convey to you, is that it is possible. We just need to look at what your individual needs are and how that fits with the available options. When you're looking at a mortgage, when you're looking at getting approved, there are 3 main factors that lenders look at: credit, income, and assets. So we're going to talk about those in that order, because really as a loan officer, when I am looking at somebody's file, that's the order that I am looking at their file to see what their options are, get them approved, be able to figure out the best strategy and those kind of things. So they kind of build on each other. When we're talking about credit, we're talking about your credit score and your credit history. When we're talking about assets, a lot of that really comes down to where's the down payment coming from? What is the down payment that you want, and where are those funds coming from, as well as closing costs. The second thing is going to be income, and that is both what you make and how you're paid and how your job history works with those 2 things. So we'll get into the details around income. And then the third thing is going to be the asset piece. And that essentially means, what down payment do you want and where are those funds coming from? Now, from the credit piece, there are a couple things that are really important to keep in mind. One is that you can see lots of different information out there in terms of minimum credit score. There's a difference between what a loan program, what the rules are, those are guidelines, and what a lender will accept, and that's called an overlay. Sometimes that's the reason that you may see differences as far as needing a minimum score. However, there are minimum program guidelines usually, and the thing to keep in mind is, like I said, sometimes lenders will have different requires what those minimums are, but for conventional actually doesn't have a minimum credit score anymore. I did put 620 on here because predominantly within the industry, most lenders, and if mortgage insurance is needed, most mortgage insurance companies are going to require a minimum of 620. In reality, a lot of times conventional buyers will have a score of around 680 or more, just simply because that's what's needed either for approval or to get the rate and the mortgage insurance that they're looking for. If they're below that 680, or for other reasons around perhaps that there's been a credit event like a bankruptcy or foreclosure, and wanting to have a shorter timeline, that's sometimes why people will then flip to FHA, because there are some differences as far as how the guidelines work for conventional versus FHA. FHA provides a little bit more flexibility that makes that the right choice for some buyers. 580 is the minimum credit score needed to put 3.5% down. That's the minimum amount required for FHA. But FHA does have an option where you could, if you're putting 10% down, your score can be as low as 500. Now, USDA and VA also don't have a minimum credit score. However, there are going to be typically lender minimums anywhere from 500 to 640, depending on the lender, for those minimum credit scores for those programs. Now, if you do have some past credit issues in terms of major credit events like a bankruptcy or a foreclosure, then you want to pay attention to what that timeline is, usually based off of whatever the discharge date or whatever the finalization date was for that credit event, because that's really what is going to start that time clock moving forward. Usually the fastest way to get into a home after a bankruptcy would be with a Chapter 13 because you can buy as soon as a year, but it is very individualized. And when I'm talking with a buyer, these are the conversations that we're having specific to what their scenario is and what their timelines look like. It would also be really great if within the last year there are no lates, but sometimes late payments are okay. It just depends on the overall picture of credit history, credit score, and those kind of things. Another question that comes up often is around student loans. And just like everything else, each loan program has a slightly different take on student loans in terms of what the payment is that's counted. Now, usually what we're caring about as a lender is we're not so much paying attention to the balance, but we're paying attention to what that payment is. The reason being is because student loans and any other debts that are on your credit report that you're obligated on go into or factor into what is called your debt to income ratio. And that's going to be your debt, your monthly debts that are in large part reporting on your credit report. There are some additional debts like child support or alimony that also count. But we're taking your debts and we're comparing that to your gross income. That ratio, that percentage, then affects your approval. Different loan programs will have different caps on what that DTI can be. So that's the reason that student loans matter so much, is because we need to know not just that you have them, but what is the payment status? Are you currently paying on them and it's reporting on your credit report? Excellent. We'll just use that payment. If you are in some kind of deferment payment program, then it depends the loan type that you're getting and what that deferment paperwork looks like. So it depends if it says that you have a zero payment or if that you are making a payment, but usually there's some additional questions and documentation that will come along with student loans that are deferred. But again, I always like to reassure my first-time home buyers that buying with student loans is possible. Don't get so freaked out about what the balance is. We're paying more attention to the payment. Now, one of the best things that you can do when you're thinking about buying a home is start this conversation early, because the more time that you have in terms of what needs to happen maybe with your credit, what needs to happen even with saving up for your down payment, but particularly with your credit, the longer of a timeline that you have, that kind of gives you more runway, right? So more time to prepare. If that's making some, changes to your credit, if that's paying some things down, if that's getting some, collections resolved, those kind of things, the earlier you start, the better. What I recommend, this is a home buyer readiness quick check, takes only a couple minutes, but it really gives you that first glimpse into your homebuyer readiness. The good news is it is not a full credit pull, so it's not in any way going to impact your score. It just gives you and me a little bit of information on what your options are, so then we can really pick the best path for moving forward to get you closer to your goal. So when you're ready to do your homebuyer readiness check, you can scan this QR code, knock that out, and get some answers very quickly. The second part when we're looking at loans is going to be paying attention to income. And the major questions that we're looking at are, yes, what is your gross income? What is your before tax income? Because that's what we're using in your debt to income ratio, which leads to your loan approval. One of the biggest questions that people have is, what about my employment history? Because there is absolutely this myth out there that you have to be on your same job for 2 years in order to buy. That may not be the case. It's really more from the standpoint of really understanding what that 2-year employment history is. Now, what can satisfy that 2-year employment history? It might be that you've been at your current job for 6 months and you were at your previous job for 18 months or more. That's great. It may be that you just started a job, but prior to this, you were in college or you were going to a trade school, or that correlates to what your current employment is. That will also satisfy that 2-year employment history. Now, where that can come into play in terms of your approval is if there are variable aspects, meaning maybe it's hourly or overtime or bonus or commission. That type of income, we usually need more details on, and you may need closer to that 2-year history. But again, the best thing to do is to ask these questions early so you have a good sense of what your path to homeownership looks like, and you don't disqualify yourself, based off of misinformation. Another thing that always comes up with income is going to be self-employment income. So how does self-employment income work, and how does it get calculated? We're going to look at if your self-employment income comes through on your personal taxes, like on a Schedule C, or if you do file business returns, then those calculations are a little bit different. But typically it comes down to kind of what is that net income. Your taxable income is usually correlated to your qualifying income. Don't want to gloss over the fact that the calculations are much more involved than that, and that's why you do want to talk with the loan officer so you get the right answers. But typically for self-employment income, we're going off that taxable income and needing anywhere from 1 to 2-year history for that self-employment income, which kind of leads itself into, okay, what about second jobs or side gigs? So in general, you need a 2-year history if you have a second job or you have a side gig that is contributing additional income. USDA does allow for as little as 1 year, so there are some exceptions, but in general, we're going to want to see if you have a full-time job and then you have a second job, or if you have a full-time job and you've got a side gig, then we're going to want to see that that second job or that side gig has been in place for 2 years. So it's not something where in order to bump up your income and qualify, you can go and quickly add a second job to bring in that income. It can definitely bring in more assets. It can help you save up for the down payment, but we do want to understand what that history needs to be in order to count that income. And lastly, talking about saving up for the down payment. When we're talking about assets, how much is needed for your down payment? When you are getting a conventional loan as a first-time home buyer, you can put as little as 3% down. A lot of people think that you have to put 20% down to get a conventional loan. You don't. There are some exceptions to the first-time home buyer, so sometimes you can still put 3% down if you've owned another home. But if somebody has owned a home within the last 3 years, they're not considered a first-time home buyer, and they would need to put at least 5% down. If you've never owned a home or haven't owned a home within the last 3 years, though, it's 3% down with conventional. FHA is going to be 3.5%, and then both USDA and VA do not have a minimum down payment requirement. Down payment sources might be a little bit more flexible than you think. So a lot of people typically think about their checking savings, which is a great place to start. But you can also tap into your 401k with a 401k loan. Sometimes some buyers will choose to do that. Sometimes they may have a family member that can gift them some of the down payment, all of the down payment, the closing cost, those kind of things. So if that's something that might be a factor for you, we would want to talk and just make sure that the family relationship meets guidelines for that loan. But then that can be an option as well to help with the bottom line. And then if none of those are on the table, but you're comfortable with the payment, credit's good, you're good with the payment and all of that, just you're short on the down payment, there are various down payment assistance programs. These programs step in and typically, although there are some variations, but typically the way that they work is that there will be a silent second, meaning that there is a second mortgage placed on the property that has provided you with funds for that purchase. A lot of times, not always, but a lot of times it's also paired up with an FHA loan. So these down payment assistance programs, some of them have payments on that second loan, some of them don't. That can depend on your income, that can depend on where you live. So there are a lot of variances as far as the down payment assistance programs that are available. They do vary somewhat state to state. And then there are national standardized programs. So this is where when I'm talking with a client, we're getting way in the weeds to make sure that we are figuring out the best strategy and tapping into available resources. The main point I want you to know right now is just that there are options out there to help you if this is something that you're looking for. So what's your next step? Next best step, if you haven't already, highly recommend doing your buyer readiness check because, again, it's going to give you a little bit of a peek of where you're at on that path to home ownership. I would love to be able to walk through any specific questions that you have. You can reach out to me directly. You can reach out to me on social. I'm the mortgage mentor across all platforms. And of course, if you complete your homebuyer readiness check, then I'll be notified for that as well. I appreciate you being here. I look forward to answering your questions, and I'll see you next time.